So, David talked a little bit about a fellow named James Montier, and years ago he wrote a newsletter on, this goes to the Pogo quote, "We have met the enemy and he is us." And we're talking now about the behavioral issue of how we choose to invest money. So this is the newsletter that David wrote. You can get a copy from our website if you like. I just thought I'd update the numbers. So the numbers come from a study by Dalbar that takes a look at tens of thousands of American investors and measures how they perform over a 20-year rolling period of time. And then they compare it to what would happen if you simply did the Rip Van Winkle approach and bought the market or bought the bonds and just compared the results. And I'm sure you know sort of where we're going with this. So this is the latest 20-year study, and up to the end of 2008. 2009 has not been done yet. And it shows that the S&P 500 did average about 8% for that period of time, but the average investor earned 1.87%. And on bonds, it was amazing that the returns were over 7% on average for this time, because interest rates were coming down for a large part of that time. And the average investor earned less than 1% a year in bonds. Now, you got to ask yourself how this is really possible, but these are the results. This is painful, to say the least, because it's 5 or 6% per year below the marketplace. And what would cause this? Well, consider this issue. This is a picture of a lobotomized monkey, and they would get that 7 or 8% return simply by throwing darts at the stock market. So they would get that return. And somehow, as a group of people, individual investors are not capable of hitting that mark. So what it says to me is this: regardless of anything else that occurs in markets in the future, investor behavior trumps whatever the markets are going to do. So these are some ideas. One of the simplest ideas is dollar cost averaging, which sounds like it's very basic, but fundamentally it works. It makes you buy more of an asset when prices fall. It works great in bear markets. It's not as effective in bull markets statistically, and it's very, very good behavioral discipline for creating wealth. So it builds wealth. This part is good. What's not so good is the next part. At some point in time, as a client, you're going to want to say, I want to start taking my money out. We would prefer you didn't actually ask that question, but generally speaking, at some point, you're going to want an income. And an income is going to consume wealth, and it generally requires this traditional approach is to use a systematic withdrawal plan. You take a certain percentage of your portfolio every month. So it's needed when one retires. It forces the sale of assets, though, on a regular basis, and that is really a wealth destroyer, as we're going to see in a minute, especially in bear markets. So the very thing that created wealth in the first place could be the worst thing that you could do when you're trying to enjoy the benefits of that wealth. So let's imagine we had $1 million. We're going back to January 1st, 2000. We have a choice of investing in any of these three markets, the American, the global, and the Canadian markets. We're going to take a look at the impact in this buying and selling in this bear market. So let's first look at the global markets. If you were buying on a regular basis, dollar cost averaging, you would have still lost 7 or 8% of your money after the decade. So that's not great, but it's not nearly as bad as the 32% you would have lost if you were counting on that portfolio to generate an income. It's 25% worse. Same investment, same time frame. For US equities, it's 14% worse. And for Canadian equities, even though the returns are positive, stripping money out on a monthly basis on what's called a systematic withdrawal plan is 34% worse. On average, you would be destroying a quarter of your wealth over a decade simply by using this method, unless you stick to dividends, and that becomes problematic on cash flow. So how bad is it? Let's imagine we just did the same thing we talked about. We took out $40,000 a year. That's only 4%, just adjusted for inflation, a couple of percent a year. What would happen to your money after 10 years? You would end up with less than $200,000 in American or global stocks. You would be not badly off with Canadian stocks because, fortunately, we had a commodity bull run. We basically didn't have a bear market in the noughties. We had an okay market because of strong banks and commodities. But nevertheless, none of the results are fantastic. Now, one of the issues that we have mentioned to clients, and we've certainly talked to some of you about, is the issue of annuities. And annuities sort of get a bad rap because essentially there are perceptions about them. The number one, they have low returns. They're locked in. There's no inflation protection. You lose all the capital at death. And they're designed for old people who have no clue how to manage their own money, so why would I want to buy one? So I understand why people don't like annuities. I understand the perceptions, but the realities are somewhat different. So the realities are this, that first off, the yields on most annuities are well above those of many other safe fixed income investments, a considerable percentage above. They're locked in, but they can be leveraged to create liquidity. You can buy indexed or non-indexed versions of annuities. You can get them to return capital. You can get them to pay an income to a survivor. You can design them any way that you pretty well want to. And the fundamental issue that they guarantee is longevity insurance, and we've just seen the impact of living too long. One of the things annuities do is you can't outlive the income. And in the cases of non-registered money, 60% of the income is tax-free. That is a huge plus. So those are the realities of how annuities work. So if we apply it to this situation here, we take this money, we split it two ways between the capital and the annuity. We are going to pay out $3,000 a month plus dividends. In other words, we're going to get our 4% income out of this with the dividends included. And here's how much money we have left at the end of 10 years. And you can see the amount we're talking about is a quantum higher in the first two cases than it would be had we just simply bought the equities, even though they're blue chip equities paying dividends. There's the difference in the numbers. They're huge. So the issue is here, we've taken less risk, we've got a more sustainable income, and we absolutely have a more sustainable model that we could potentially use indefinitely for years and years and years. So just remember that annuities definitely have a place to make equities work. So in the last 10 years, it's interesting, but annuities have actually outperformed for the last 10 years every one of these asset classes, global equities, bonds, Canadian equities, and Canadian bonds. Each one of them has earned less than just an ordinary vanilla annuity. We've talked about the issues that matter in investing: cash flow, balance, diversification. David talked about our returns. I want to focus on the fact that the cash flow portion is really critical to us. Of our return that our clients have earned in the last 10 years, about 6.5% a year net of fees, 80% of that return comes from cash flow. Now, why does that matter? Well, let's go back to this graph here. For one of our clients in that balanced portfolio, which is diversified but does also focus on cash flow, this is where they would be today in relation to all of these other outcomes. And so we find it very important, whenever you own an asset, in a perfect world, you're never required to sell that asset to generate the cash flow you need to retire on. You want to focus on the cash flow it's generating and ideally try to do the things to make that cash flow very tax efficient if possible. So that's what our focal point has always been in any portfolio we create.